Hello, welcome back. You're listening to the Royalty King. And yesterday I was interviewed on VRIC, the Vancouver Resource Investment Conference, talking all about royalties. I was asked to come on there and give some commentary and was able to make some statements. Perhaps they might need a little more clarification. So if you watched that interview and you're still wondering about certain things that I said, here I think is a great chance for us to go through, and I'm going to visually explain some of the concepts to which I was referring. So time for me to share my screen. This is the hardest thing for me, is the technology, as always. Go into a nice little slideshow, and hopefully this is going to make things make a lot more sense, to really give some clarity to some of my comments. So if you haven't already seen on the Substack, go over to Substack, the Royalty King, subscribe, and you'll be able to get access to the Royalty King's report, which is a big research report that I've done most recently on the Masabi Trust. And why this is so interesting is because it's a case where you get about as good a comparison as you're ever going to get between comparing the performance of a given commodity, an operator of that commodity on a given deposit, and then a royalty trust that has a royalty agreement for not just that commodity, but with that specific deposit, with that specific miner or producer. So Masabi works alongside Cleveland Cliffs. You can listen to the interview or you can read the article to really get up to speed. All I've done here is compare the price performance ex dividend. So Masabi actually even outperformed further as far back as I can get TradingView to go with the given iron ore futures. So you can go back even further if you wish. You can take iron ore out and you can look at simply Masabi, and you can look at Cleveland Cliffs. Since 1961, when Masabi was incorporated, and you'll see that the thing just outperforms, it kills it. If you are able to dig a little deeper, you'll look and find that over the long term, on a nominal basis, the iron ore price has increased at a CAGR of around about, or compound annual growth rate of around 4%. So iron has been going up roughly 4%, and Masabi and Cliffs have done, well, not Cliffs actually, Masabi has done very, very well in comparison, starting with an iron ore price of around 10 or 12 bucks all the way back in the early 60s. What's interesting about this chart is at the limits that I could get in terms of getting the iron ore price futures tracked here, you'll see that the operator has actually done worse than the underlying commodity. So this is a miner that develops iron ore and sells iron ore, and yet Cliffs has done terribly compared to the very thing which it sells. And obviously Masabi, being just literally a collection of documents, a royalty agreement, has been able to clip a piece off the top line through thick and thin, and has really enabled it to compound. So as the iron ore price rises nominally over time, they get a clip of that, and they also get a clip of any increased production according to a bonus schedule, which I alluded to and went into depth in the Substack. So I won't repeat that here. I'll just invite you guys over to take a look. So let's take this idea and let's use a few other comparisons. So everyone's talking about gold and silver at the moment in the natural resource world. Here we're looking at Wheaton Precious Metals, because Wheaton is more of a pure play on gold and silver, as opposed to some of the others that have either polymetallic interests or other small interests in royalties in oil and gas, etc. And I've compared this to Newmont, Agnico Eagle, and Barrick, and then obviously the commodities themselves, so gold and silver. So gold and silver currently up 8.7 and 6.4x over this amount of time that I've been able to work out since Wheaton's inception. So that's why this time series was used. You can see the commodities have done better than two of the producers. The only producer that actually did better was Agnico, and I think that was a lot to do with that has actually been the performance of Kirkland Lake, with which it ended up merging. But anyway, we can see here, regardless, that Wheaton Precious has absolutely killed the commodities themselves, and all the major producers really that you could consider in the space. It's increased by many factors. If you were to add the dividend back in, you actually add about an 8x or 800% to Wheaton's performance. So the same thing holds true across commodities now. I've already shown that, and so you guys can see this can't be anything commodity specific. It has to be something to do with the underlying economics of the business models in question. You might look and think, well, Agnico Eagles, that did pretty well. I mean, that's worth consideration, isn't it? Well, you've got to. That's only half the story. Looking at their performance, looking at the earnings is only half the story. The chart I showed before measures stock price. You got to ask yourself how they were funding that. So if you look at the dilution here, it gets a bit messy because of the height factor in the aggregate, but I'm going to account for that in the next slide. If you look at the change here from Agnico down at 89 million shares, all the way up to over 500 million, it shows just how they were able to achieve those results. And this needs to be factored in because simply looking at a price rise and price performance over time is not going to be enough. You really need to look at a total shareholder return on a per share basis. And so I have taken the liberty here to explain this a little further. So we've got the start of the period and end of the period in shares, the overall aggregate increase, and what that works out to be is a compounded annual growth, or in this case, probably better to say compound annual dilution rate. So if you look at Agnico Eagle, that thing has actually inflated its share count more than the fiat currencies, if you think about it. So everyone's talking smack about the US dollar, but the US dollar has only decayed at sort of 7.4, 7.5% over the longer term. That may well be due to change, I agree, but we have to take things as they stand right now. And you've had more inflation in the share count of Agnico Eagle than you have in the US dollar into monetary supply. So I thought that was quite interesting. Wheaton, of course, has issued more shares. Not all royalties. In fact, most royalties do not increase shares because they cannot. If you look at some of the express trusts that I've gone into on the Substack, you'll see their trusts, they actually don't have the dilution risk because it's impossible for them to issue more units as per their mandate. So you have no management risk, you have no dilution risk, you have no operational risk. It's just, as I mentioned in the interview, it really is a superior business model. And I hope that I'm starting to flesh that out visually for you guys to gain an appreciation. What I'd like to comment on in terms of Wheaton's dilution is that it's really so funny. People might use that as a criticism. They shouldn't because it's been less than the fiat currency. But anyway, looking at that, Wheaton's advantage is the very same criticism that most people have when it comes to royalties, which is their market multiple. People say they trade at such large multiples to their earnings. Well, that's where you want to issue shares if you're ever going to do it. If you're issuing shares at a premium, to invest in accretive deals. Now, I don't love dilution of any form. I like the Express Trust idea. It's a one and done, a financial investment, and everything else is astronomical, infinite returns on my capital once I've earned my capital back. In this case, capital light business model continues to be very, very intelligent way that Randy and the team have expanded Wheaton over the last 2 decades, because when everyone else was struggling going through the bear markets, they were able to use this equity to get these accretive deals, which can still pay off well into the future, especially when we're talking about funding deposits that have not become economic yet because they were waiting on a call option on a higher gold or silver price. Okay. Agnico Eagle's return on equity versus Wheaton's return on equity, you can see the difference there. And I think that this is really, really important. So you just look at 1 year technically of negative return on equity for Wheaton. The rest has all been a very, very healthy return on equity, especially when you compare it to Agnico. So here are the averages that I've just kind of put together for you guys to have a quick overview. And you can see the difference in terms of the structure, in terms of what is required to be a miner and an operating company versus what is required simply to be technically a finance company, albeit a highly specialized geology/finance company in wheat and precious metals and streaming. So, what about another totally different commodity? Let's go over to the energy markets. I could do this all day, but this will be the last one. I promise before we get into earnings ain't earnings. Here we're looking at the oil market. Obviously, we've got Texas Pacific Land Trust, and then it became a corporation. And you've got Exxon, as Uncle Rick says, the finest oil super major on the planet. And then you've got the price of oil using WTI. You could use Brent or a different version, but really here, when we're talking West Texas, it makes sense to use West Texas Intermediate, right? So over the longest period of time that I could find, at least on TradingView, you can see the performance of TPL without dividend. I think that basically speaks for itself. I don't think I need to tell you how good that is. You look at ExxonMobil and then you look at the underlying commodity. And we're really looking at the difference between the two to compare the business models, not to make fun or to criticize Exxon. It's just simply to understand. Another point I brought up in the interview is that barring 3 commodities that I know of at least, the rest of the overall real price, not nominal, but of inflation adjusted real price of commodities goes down over time because you've got all these super majors bringing more and more production and into the global supply. And as a result of that, these guys are just drilling, exploring, and M&A machines, which is obviously a capital intensive process, and hence give it enough time, you'll see the difference between a capital intensive and a capital light business model. Now, I've put this in because someone might ask about the dividend. The dividend really doesn't mean anything in terms of comparing the two, right? So here I've used a total return chart to account for the dividend, and over the last 2 decades as well, again, fitting with what I could get in terms of max time horizons. TPL absolutely smokes Exxon almost by a multitude of factors, order of magnitude, almost really incredible stuff. Here's another thing, might sound a little bit contentious. I made a comment in the interview, and I want to really flesh this out, that earnings ain't earnings. So people talk about royalties and they say that they're overvalued or they say they're too expensive. And I think that's more of a reflection on the person's understanding than someone that's actually had a look at outside of the broad brushstrokes quantitative analysis, understanding what this can mean projected out into the future. So if we have an operator, we're just using, for instance, Cleveland Cliffs. I'm speaking metaphorically here, okay? I'm just conceptually trying to make the point. Let's say there's a reported earnings or putative earnings of $8, the PE of 8, as judged by the market, and the stock price, therefore, we would expect to be $64. All very straightforward stuff. But really, of those earnings, there's so much accounting and trickery that goes into the earnings being so far down on the reported income statement, point number one. Point number two is that these types of businesses need to continually maintain and then invest above that maintenance level. So you've got your maintenance CapEx and you've got your growth CapEx. And that means that if you really look, if you reconcile and go through different years on the 10Ks, or if you use this software, I won't do it now because you'd be bored, but you can see the difference between the reported cash flows and then the GAAP earnings per share. And it's astonishing sometimes the difference between the two. If you follow revenue, operating margins, and you go all the way down, and then you account for share dilution, it's like, wow. Let's say overall, there are certain people that would use a rough rule of thumb that would say about 20 to 25% of those earnings are actually available for the end users. And that does track with the margins and the payout ratios. So let's say 25%, let's say out of those $8, $2 are really available for the shareholders. That's what you really want if you're investing. You really want to know how much is available to you at the end of the reporting period, right? So therefore, it might be more correct to actually say the PE, in fact, is not 8. If you look at a PE in terms of what earnings are available to you as a shareholder, perhaps it's more like 32. And that starts to put it into a very, very different perspective. When you look at in this case, I just use Masabi as a 13x PE. In what world is that expensive? I don't really understand. And again, I didn't go through and do a whole heap of slides here or anything like that because you'd be bored. But if you take a look at the 10K or 10Q of basically any operator you want, and you'll see the cash flow per share versus the gap EPS does fit around this 20 to 25% ratio. In any case, looking at a historic PE for Masabi does not look to be particularly expensive to me if you're paying 10x the next year's expected earnings. Almost all of that will be paid out to you in that same year. So there's no time value of money problem. And the thing just continues to compound. You don't have to tip anything out of those earnings back into the operation of the company, really. The maintenance expenses are less than 3% last I checked. Wheaton Precious Metals, here's a good example. So Wheaton trading at 33.4 or 33, rounded up to 34 times earnings. Agnico, 46.5 times earnings. So already actually Wheaton's trading at a cheaper valuation, which might sound funny to people, but it's probably not what most people would expect. I know what you're going to see. You're going to see there's this big spike here in 2016, and you're correct. I adjusted for that as well, and it really makes no difference. It starts to trade basically around the same mean multiple over that time frame. Okay, so why would you want to pay the same effective price, or really would be more if you account for how much of the earnings are going to drop to your bottom line, when you could buy the best in the class? Don't understand it. Exxon versus TPL, just to kind of complete the thought. This, I changed it a little bit to kind of give it a bit more distortion, and I think it's super interesting. So if you forget about the accounting trickery with earnings just for now, and you look at the sales, so top line sales, before any accountant can start to play around with the numbers. As of today, you would look, or if you were an algorithm, or if you were just some kind of punter out there, looking at this, you would get a EV to revenue screen multiple telling you that Exxon was only trading at 1.3 times sales versus TPL, which was trading at over 20 times that number. So nearly 22 times the sales. So obviously you would look at that and you would say TPL is way overvalued, right? Well, that's not the whole story. So let's take a look. If we look at the net income to commons as sort of our margin, so how much net income is available to the shareholders once you go through and account for all the expenses, this has much less like readjustments on a gap level. So I think it makes sense to use this metric. You can see the difference in the quality of the business straight away. It smacks you in the face. So your profit margins, your end of the day profit margins, net income, everything for TPL barely dips below 60% over the time period. Whereas if you look at ExxonMobil, it's single digits bar 1 to 2 years, and it actually had a negative year, obviously around COVID in 2020. So let's stop right there. COVID probably is the worst environment we've ever seen for oil producers, right? Or anything to do with oil, selling oil when oil contracts went negative. And for that quarter, I think they averaged like $20, okay? Way below anyone's producing costs. Yet look here what happened to the margin for TPL. TPL dipped from like 65% to 58%. Most people would kill to have those margins at the best of times, okay? So what does that mean now? We're paying $1 for revenue. Let's adjust for the margins and we'll see whether or not Exxon really is far cheaper than TPL. It might surprise you. So we'll do Exxon first. Again, I've tried to simplify it as much as I can and keep it visual so it's easy to follow. You pay $1.30, let's say, of an investment for $1 of revenue. 13 to 14 cents on average is really going to drop to the bottom line. So your EV to earnings equivalent, if my math is correct here, it actually comes out to more like any sort of 9 to 43x. So actually, you might be paying like tech multiples, but you think you're in a commodity business. Yes, that can change with the oil price, I know, but that's the point because you don't know where the oil price is. TPL is going to be clipping the ticket even when oil prices go negative on a day, which we saw before. So it's not what you think. You think you're paying one-time sales. Better to look at how much of that you're actually going to have access to. TPL in that respect is actually easier to analyze. There are lots of things about TPL that are not easy to follow, but this I think is. 20x revenue, let's just say $20 for a dollar's worth of revenue. But let's call it 60 to 70% turns into profit. You're converting that into an earnings equivalent, 28.5, 33x. Okay, so if you look around the midway, 30x enterprise value to earnings. Okay, it's not like a screaming cheap earnings yield, but compared to the fragility in the major indices and compared to the commodity producers and the commodity that sells, you've seen now with the charts why this starts to make sense over time, that people just, they do not understand the value in the tails of the deposits. They don't understand the compounding of these types of businesses. So my goal today was to briefly and very visually kind of put together my thoughts in terms, well, with the hope that this would help explain a lot of them, because sometimes it's a bit difficult to do it without the visual aids. Thank you so much for watching. Please do like and subscribe. And if you like what I'm bringing out in terms of content, you must head over to the Substack. That's my main neck of the woods where I put out my publications, and you have long form research reports and my thoughts in general. Thank you very much, and I look forward to catching you in another episode. Take care.